welcome to our presentation here on the latest modification software to hit the market to help deal with the current economic crisis that's going on. We're going to give you a quick presentation here, and first off, the objectives of our presentation are to show the historical events that have led to our current global recession, discuss and evaluate the mortgage and housing crisis that's going on today, review currently proposed solutions, present a valuable tool to successfully navigate through the financial storm that we're seeing today. And lastly, we're going to share with you how Qualify to Modify can work with you to correct the problems that are lingering on the horizon. So the big question is, how did we get here to the current state of our economy? Well, number of things. Number one was deregulation of the financial system and limited oversight, historical low interest rates, relaxed lending guidelines, and as you can see here, basically lending guidelines were just non-existent. So we've got a little funny cartoon. Look, I know we approved you for a subprime mortgage, but how are we to know you'd default? You know, the funny thing about that is that it really did get as easy to where a dog may have been able to qualify for a loan. We've had excessive housing production, which led to rapid home appreciation rates, and housing to income affordability was basically thrown out the window, along with not needing any skin in the game, limiting down payments, and you know, just another kind of joke, I guess, on the issue here is, gee, I'd like to buy a house, but I haven't saved any money for a down payment, and I don't think I can afford the monthly payments. Can you help me? Sure. Since the value of your house will always go up, we don't need down payments anymore. And you know, it really did become that way. So unfortunately, that's why we're in the situation that we're in. And lastly, the fact that credit was so easy, it really contributed to a great deal of consumer overspending. Right here we have a graph of historical conforming 30-year fixed rates dating back to 1993. And when you're looking at this graph, really look at what we have circled here, where that starts. That's about where 9/11 was. And since that, post 9/11, interest rates have just dropped dramatically from where they were prior to that historically, as far as low points. Right here we have a stimulus package being passed, and you can see interest rates have dropped drastically since that state as well. While we like to see low interest rates, unfortunately getting them this low really could probably lead to more troubling issues rather than good. This section right here, this is the subprime years where lending was just, where guidelines absolutely really were non-existent at this point. Anybody could get a loan, and as you can tell, no guidelines and low interest rates. Well, look where it's led us today. Prior to that, the lowest point for interest rates prior to 9/11 was actually about where the peak of interest rates were during the time of the easy lending period. So interest rates were just really out of whack, causing people to buy things that they really just could not afford. So what does this all mean? Well, that section there, it goes to show that really most government policies and laws, procedures, pretty ineffective. Congress has pushed lenders to lend to unaffordable Americans. Most of 2004 plus borrowers were actually flat broke. They didn't have any skin in the game, and they were living paycheck to paycheck, yet lending guidelines approved them for home mortgages. Full documentation mortgages were approved as high as 65% plus gross to income ratios. What does that leave for discretionary income? You know, I mean, our country is going to see these problems just continuing to unfold for the next several years. So we need to contrive a solution to fix this issue today. The brutal facts are this. Since late 2007, 345 lenders have gone out of business. 100 banks have failed. We've had 80 failed large corporate builders. We've had 181 brand name corporations either file for bankruptcy or go out of business. We've seen home values depreciate very rapidly. There has been an inability to refinance current balances. The increased payments from these adjusting interest rates are really hurting individuals' pocketbooks at home. The historical highs for defaulted loans, servicers and lenders lacking needed resources and technology to address these climbing defaults. So that's what's going on right now. And this has really led to unaffordable mortgage payments, an oversupply of housing inventory, declining property values, tightening credit qualifications, which include increasing FICO score requirements, decreasing loan-to-value ratios, decreasing debt-to-income ratios, instituting loan-level price adjustments. Private mortgage insurance has restricted what they will and will not write policies on. And then we've had an elimination of unsecured credit lines altogether for many individuals, which has unfortunately led to failed businesses, which of course goes to losing jobs and eliminating retirement accounts, causing more foreclosures, which right now we're seeing that 1 in 5 homes are underwater, or actually there is more in liens on the property than what the property is really worth. And with the high unemployment rate and all the other combining factors, currently we have a default rate in our country, which means that people are at least 60 days past due of their due date. 1 in every 10 mortgages is in default. The reality of this situation is that we've had a great deal of government interference. They adopted Fannie Mae and Freddie Mac, putting them into conservatorship, thinking that that would help the problem. They created lending programs and tax credits, trying to solve the issues. Programs such as the FHA Secure and the Hope for Homeowners. And unfortunately, these aren't working either, because the government isn't the one lending the money. It's the institutions that have the money, and so they're not abiding by the new government mandated guidelines. They don't want to lend their money based on the guidelines that the government says they have to. So they've been created, yet they're just not accepted. We have lender and servicer call centers that are greatly understaffed, and people are completely overwhelmed and inundated with the volume that's coming in. They have no system to determine a homeowner's true position of affordability, and they have no automated system to control the amount of climbing defaults. And currently the policies that they have in place just are not working. Estimates show that 70% of current modifications redefault within 90 days. Home values in neighborhoods continue to decline. So it's not a pretty picture right now. Economic homeowner challenges. We have unaffordable loan terms, adjusting rates, recasting loans, rare cases of mortgage fraud, loss of jobs and household income, excessive debt. People are filing bankruptcy in record numbers. It's causing financial strain, which is causing divorces, and it's causing illness and death. So this is pretty ugly. So what do we see that's on the horizon? Well, we believe that unemployment will continue to rise. We're going to have out-of-control consumer debt, which is going to lead to an inability for the consumer to pay. Families will start making